Real Estate Intelligence Daily, June 9, 2026. PropTech, Finance, and Commercial Market Insights. Out of this world trends redefine real estate. Commercial real estate finance. The commercial real estate finance environment in mid-2026 finds itself in a delicate balance of resilience and uncertainty, as the sector navigates a higher interest rate landscape and newly cautious credit conditions. The Federal Reserve's rate hikes from recent years have largely paused, leaving average long-term borrowing costs in the low 6% range for commercial mortgages, a slight reprieve from last year's peaks, yet still elevated by historical standards. This stabilization has offered some relief to borrowers, prompting an uptick in loan applications after a prolonged slump and drawing previously sidelined investors back into the market. Banks remain well-capitalized and liquid, but they face heightened regulatory scrutiny and are curtailing new real estate lending to riskier segments like aging office buildings. Market participants note that sentiment has shifted from the aggressive, yield-chasing environment of the past decade to a more measured stance where quality, cash flow resilience, and prime location are essential for any project seeking to secure financing. Publicly traded real estate investment trusts (REITs) likewise are moderating growth plans and tapping strategic private capital partnerships to fortify their balance sheets in this higher-cost capital regime. Yet beneath the surface, stress points challenge this fragile equilibrium. Office properties remain the epicenter of concern, as lease demand shifts and valuations drop. A growing share of office landlords are struggling to refinance maturing mortgages, pushing commercial mortgage-backed securities (CMBS) delinquency rates to multi-year highs. A wave of loan maturities is testing borrowers' ability to roll over debt, particularly for older office towers in slow-to-recover downtowns now facing valuations at a fraction of their peak, which has intensified pressure on both borrowers and lenders. In response, creative workout strategies have re-emerged, splitting distressed loans into A-B tranches, injecting rescue capital, or extending maturities, though each situation is highly deal-specific and contingent on factors like property quality, sponsor support, and regulatory constraints. Multifamily and hotel loans show more resilience with varied performance, while well-leased industrial and data center assets continue to find willing lenders even as underwriting remains disciplined. Investors are bracing for a potential increase in distressed asset sales later this year, though many believe ample dry powder among private equity funds and debt funds might prevent a wave of fire sales by enabling strategic recapitalizations to stabilize viable properties. Despite these headwinds, commercial real estate finance is far from frozen. Instead, it's selectively dynamic in areas that demonstrate resilient demand or strong fundamentals. Private credit funds and non-bank lenders have stepped up to fill gaps left by retrenching banks, becoming a permanent fixture of the capital stack for deals where traditional financing has grown scarce. High-profile transactions continue. Just this week, a global private equity giant partnered with a major bank to provide a multi-$100 million refinancing across a portfolio of logistics properties, signaling that well-performing assets can still attract financing even in this expensive credit environment. Opportunistic investors are also scouring the market for bargains in the debt space, acquiring discounted loan positions or partnering with embattled owners to inject capital in exchange for equity stakes when markets recover. New CMBS and CRE CLO issuances persist, albeit at lower volumes, with single-asset, single-borrower deals leading activity, evidence that capital markets remain open for the strongest sponsors and properties. Across the board, the industry is touting a back-to-basics ethos. Projects with dependable cash flows, future-proof design, and prime locations stand the best chance of securing funds, as stakeholders take a long-term view. Much like planning a colony on new worlds, to ensure assets financed today can thrive in a transformed economic landscape. Subtopic: Commercial Finance Highlight. Industrial Portfolio lands $281 million refi. Just today, Blackstone and J.P. Morgan announced they have jointly secured a $281 million refinancing package for a major industrial real estate portfolio, demonstrating that well-positioned deals can still attract capital in this environment. This financing, which covers 77 last-mile logistics and industrial outdoor storage properties across 12 major U.S. markets, allows the owners to refinance existing debt and fund growth plans at a time when many commercial borrowers are facing steep refinancing hurdles. The deal is noteworthy not only for its scale, but also for its focus on a niche asset class, industrial storage yards critical to e-commerce and supply chains, which has held up well even as other commercial property sectors stumble. Analysts say the involvement of a global private equity giant and one of the country's largest banks signals that institutional capital remains available for high-quality commercial real estate assets, demonstrating strong income and strategic importance. The arrangement reportedly includes a creative financing structure with senior and mezzanine tranches, reflecting a risk-sharing approach between the two lenders as they navigate elevated interest rates. Market observers see this move as a vote of confidence in industrial real estate's resilience, reinforcing how selective capital is being deployed to segments viewed as essential to the modern economy. In an era of expensive credit and uneven property performance, deals like this underscore a broader trend. Capital will flow to sectors positioned to thrive, even as the industry's less competitive assets face more financial strain. PropTech and AI analytics. PropTech and advanced AI analytics in real estate have moved from the periphery to center stage, fundamentally transforming how properties are developed, marketed, and managed. What was once considered experimental technology is now mission-critical. By 2026, nearly three-quarters of major commercial real estate firms use at least one AI-driven tool in core operations, almost double the share from just 3 years prior. In practice, AI and analytics are being woven into every link of the value chain. Sophisticated machine learning algorithms now instantly evaluate property data and rent trends. Predictive models anticipate maintenance needs and tenant turnover, and generative design software simulates new developments virtually to optimize building layouts and energy efficiency. Real estate companies are increasingly leveraging massive datasets, from satellite imagery to social media trends and foot traffic patterns, feeding them into AI platforms to forecast market demand and unearth hidden investment opportunities. The rapid improvement of AI capabilities, including chatbot assistants and specialized property digital twins for planning, is unlocking cost savings and insights that were unimaginable a decade ago. This technological leap is ushering in a new era of data-driven decision-making, one that embraces a futurist approach to property strategy that some liken to planning a city on a new frontier. An analogy that underscores the unprecedented scope and ambition of today's real estate innovation. In the broader industry, PropTech is no longer a niche topic reserved for tech specialists. It's a top priority in real estate boardrooms and global conferences. This month alone, hundreds of property executives convened at summits in New York and London focusing exclusively on AI and digital transformation in real estate, highlighting how the conversation has rapidly shifted from theory to the tangible impact of technology on day-to-day business. Industry leaders are sharing case studies of AI-fueled successes, automating leasing tasks that once took weeks, using computer vision to spot building maintenance issues, and unleashing predictive analytics to detect early market shifts with remarkable accuracy. Smart building systems, from IoT sensors regulating energy use to integrated tenant experience apps, have quickly become standard expectations in modern commercial properties, boosting efficiency and tenant satisfaction. Meanwhile, 3D virtual tours guided by AI, automated valuation models, and virtual assistants that help homebuyers are reshaping how real estate is marketed and transacted, making deals faster and more transparent. As real estate firms large and small now collaborate with tech innovators, the focus has turned to measurable outcomes, how these tools trim costs, reduce carbon footprints, and enhance returns. Far from a novelty, PropTech and AI have cemented themselves as essential building blocks in the property business, driving a wave of progress that is overwhelmingly positive and transforming the industry's long-term trajectory. In terms of financing and market momentum, PropTech is attracting substantial investment and delivering measurable results. After a short-lived pullback during the pandemic era, venture capital and corporate funding in the proptech space has roared back with fresh discipline. Just last month, real estate tech firms raised over $350 million across 39 deals, one of the strongest months in recent memory and a sign that investors see lasting opportunity in tech-driven real estate solutions. Much of this capital is flowing to startups directly tied to boosting real estate performance, such as construction automation, tenant experience platforms, and AI-driven property management software, indicating that investors are prioritizing technologies with clear revenue impact. Established real estate and tech companies are also joining forces. Traditional brokerage and development firms continue to acquire proptech startups to bring innovation in-house, while large technology providers are tailoring solutions specifically for real estate use cases, like predictive maintenance and market analytics. As these technologies scale, regulators and industry bodies are keeping a watchful eye to ensure they benefit consumers and maintain fair competition. Topics ranging from data privacy to algorithmic transparency are now part of the proptech conversation. Overall, the mood in the proptech and real estate analytics community is one of optimism and forward-looking energy. After years of experimentation, technology is finally delivering real value on the bottom line, aligning the industry for a future where digital and physical real estate strategies are inseparable. Subtopic: PropTech Spotlight. Lawmakers scrutinize real estate portals. In a high-profile regulatory development, 2 U.S. Congress members have urged the Federal Trade Commission, FTC, to investigate the referral practices of major online real estate platforms. In a letter dated June 9, lawmakers Jennifer McClellan and Don Bayer requested a probe into whether deceptive lead generation tactics on listing portals might be secretly steering homebuyers to certain real estate agents or lenders without proper transparency. Their inquiry specifically name-checks Zillow's Flex Agent Referral Program, which has been accused in lawsuits of funneling unsuspecting buyers to agents who later owe Zillow a significant portion of their commission, potentially inflating costs for consumers. The legislators expressed concern that such opaque online steering could be aggravating already skyrocketing housing costs and undermining public trust in digital real estate services. Zillow, the largest U.S. real estate portal, has defended its practices as aboveboard, saying users are always free to choose any agent and that the company's terms make such relationships clear. It views recent lawsuits as mischaracterizing its business. Critics, however, argue that the online marketplace needs stricter oversight to protect consumers from conflicts of interest and hidden fees. The FTC has not yet responded publicly to the call for investigation, but this request illustrates an inflection point where PropTech's rapid evolution is meeting rising regulatory scrutiny, underscoring the need to maintain consumer trust even as technology profoundly reshapes the real estate industry. Construction and development tech. The construction industry in 2026 is at an inflection point, tasked with building faster, greener, and smarter in an era of tight labor markets and high costs. Rapid technological adoption, from AI-driven project management to on-site robotics, is transforming how buildings are designed and delivered, enabling contractors to work with speed and precision in ways that were implausible just a decade ago. Predictive algorithms now foresee scheduling delays and budget overruns before they happen, and architects leverage generative design software and 3D modeling to perfect building plans virtually, eliminating many errors before ground is broken. These innovations come at a critical time. A widespread shortage of skilled labor, rising material expenses, and demand for more sustainable construction methods have forced the industry to innovate or be left behind. Public and private stakeholders are instituting sustainability mandates, from using low-carbon concrete to meeting strict waste reduction targets, which is fueling investment in green construction tech and compelling contractors to adopt tools that measure and minimize a project's environmental footprint. All of this means construction technology is no longer optional. It's a strategic imperative in a highly competitive field, separating forward-thinking builders from those struggling to keep up with the demands of modern infrastructure and climate resilience. Certain construction segments are seeing especially intense innovation and investment. Data center construction, for instance, has become one of the fastest-growing niches, propelled by the global race to expand cloud computing capacity and AI-focused data centers. Multi-hundred-million-dollar projects to build massive server farms are breaking ground from Northern Virginia to the Pacific Northwest. At the same time, venture capitalists have been pouring money into ConTech startups that tackle construction's age-old efficiency problems. In May alone, more than half of all PropTech funding globally went to construction and development technology firms. From robots automating repetitive on-site tasks to software platforms that streamline procurement and handle 3D printed building components, these investments target the industry's greatest needs, boosting productivity, easing supply chain bottlenecks, and mitigating schedule and cost risks. Modular and off-site construction techniques have gained mainstream traction as well, as factories build standardized apartment modules that are then assembled on-site more quickly and with less waste. The result is an increasingly high-tech construction ecosystem where every phase, design, permitting, building, and operations, is being digitally optimized, pushing the boundaries of what can be built and reducing the time and cost it takes to bring new buildings to life. Crucially, the boundaries of construction innovation are extending into realms that seemed like science fiction not long ago. The integration of digital technology with physical building processes is opening up dramatic possibilities, from 3D printed homes on Earth to visionary plans for constructing off-planet habitats with AI-guided robotics. Developers now create digital twins of projects to simulate construction and maintenance scenarios before the first brick is laid, improving safety and allowing architects to attempt daring designs with fewer risks. The lines between construction and technology are blurring as traditional engineering firms partner with Silicon Valley companies or even acquire ConTech startups outright to bring cutting-edge expertise in-house. Whether it's streamlining permit approvals via online platforms or deploying fleets of drones to monitor job sites in real time, construction and development now operate hand-in-hand with technology to an unprecedented degree. Looking ahead, industry leaders envision a time when buildings and infrastructure can be delivered with assembly line efficiency and minimal waste, achieving leaps in scale and complexity that once seemed as distant as building a city on the moon. Subtopic: Construction Tech Update, billion-dollar ConTech acquisition. In a blockbuster industry deal, global design software giant Autodesk announced it will acquire maintenance management startup MaintainX for $3.6 billion in a bid to expand its construction technology portfolio. The acquisition, unveiled just days ago, underscores how established players are investing heavily in automation and digitalization to tackle persistent inefficiencies in construction and building operations. MaintainX is a venture-backed platform specializing in mobile software that helps contractors and facility managers digitize work orders, track equipment maintenance in real time, and analyze operational data to reduce costly downtime. By integrating this toolset, Autodesk aims to extend beyond its traditional design software core into the full lifecycle of building projects, launching a new division to fold maintenance and operations analytics into its services for contractors, property managers, and owners. The timing is notable. Many see this as a strategic move to capitalize on the surging demand for construction tech solutions, as firms seek to offset labor shortages and cost pressures with digital tools, and as investors double down on ConTech deals. Industry analysts call this one of the largest acquisitions ever in the construction tech space, reflecting a broader trend of tech giants and building firms racing to lock down innovative solutions and talent. As the digital transformation of construction accelerates, major companies are betting big on the idea that leveraging technology is essential for those constructing the world of tomorrow. Insurance and risk management. Managing risk and securing affordable insurance have become central to real estate strategy as climate change and market volatility upend traditional assumptions. More frequent and devastating hurricanes, wildfires, floods, and storms have pushed annual insured property losses above $100 billion in the U.S., turning once rare 100-year disasters into regular occurrences. Insurers in especially high-risk regions have responded by dramatically raising premiums or even halting new policies. sending shockwaves through property markets in states like California and Florida, where homeowners and landlords have faced steep rate hikes and limited coverage options. The knock-on effects are substantial. Real estate transactions and valuations increasingly depend on the availability of reasonably priced insurance, and lenders now weigh climate resilience and hazard exposure when deciding on loans. In many markets, insurance costs and property taxes are making up a larger share of total housing costs, adding a new wrinkle to the affordability challenge for both renters and buyers. The real estate industry is grappling with how to adapt to this new reality, balancing the need to invest in resilience and risk mitigation while striving to keep properties insurable and financially viable for communities and businesses. As the risk landscape evolves, innovation is becoming key to maintaining insurance capacity and managing uncertainties. Insurers and risk managers are deploying high-tech predictive models that integrate dozens of data points, from roof conditions and forest density to up-to-the-minute weather data and historical loss patterns, to refine how they price and underwrite property risks at an almost individual building level. Advanced AI-driven platforms can now process enormous volumes of environmental and asset data, pinpointing vulnerabilities in an insurer's portfolio and highlighting where catastrophe exposure is too concentrated. On the ground, real estate owners are becoming more proactive in partnership with insurers, installing sensors for fire and leak detection, elevating or floodproofing critical infrastructure, and taking other mitigation steps to earn premium credits and ensure insurability. State governments are also stepping in. New laws in several states aim to stabilize insurance markets after years of crises, enticing insurers back by capping excessive litigation and providing reinsurance support, while also funding resilience measures like community seawalls and updated building codes. For instance, Florida's recent legislative reforms have drawn roughly 20 new insurers into the state's homeowner market with over $850 million in fresh capital, reversing a downward spiral and yielding early signs of moderating premium costs as competition returns. In effect, the real estate sector is shifting toward a proactive risk management culture, using better data, smart technology, and collaborative policy solutions to navigate a world where physical risks are intensifying but can be mitigated with foresight. In the broader picture, capital markets are increasingly intertwined with property insurance outcomes. Global reinsurers, the insurers of insurance companies, have shown a renewed appetite for property risk in the 2026 reinsurance renewal cycle following several years of painful losses. This influx of reinsurance capacity is expected to gradually help soften direct insurance rates for some property owners. Meanwhile, alternative risk transfer solutions like catastrophe bonds and insurance-linked securities are attracting more institutional investors, injecting fresh capital and spreading the financial exposure of disasters beyond the traditional insurance industry. Such instruments can cushion the impact of megadisasters by allowing global capital markets to absorb some of the shock, potentially strengthening the system's overall resilience. On the retail side, innovative products such as parametric insurance, which pays out automatically when parameters like wind speed or rainfall reach a certain threshold, are gaining traction, promising faster claims payouts to businesses and property owners after extreme events and illustrating a forward-thinking shift in how risks can be shared. As climate scientists warn of increasingly severe weather, real estate stakeholders are developing a mindset focused on resilience and adaptation, blending time-tested risk management practices with cutting-edge data tools. The evolution of insurance and risk strategy in real estate shows a sector not just reacting to present threats, but actively fortifying itself for future uncertainties, determined to weather any storm, literal or figurative. Subtopic: Insurance Tech Launch, AI-driven climate risk platform debuts. A new InsurTech platform launched today aims to revolutionize how insurers and investors tackle climate risk and property hazards. Miami-based Neural Earth introduced Prometheus, an advanced decision intelligence system that unifies and accelerates slow, fragmented risk management workflows into one real-time, AI-driven platform. Prometheus ingests massive streams of data, from satellite imagery and IoT sensor feeds to catastrophe models and insurance claims, and uses artificial intelligence to deliver instant, parcel-level risk assessments and actionable insights for property and casualty insurers, reinsurers, and real estate portfolio managers. By consolidating information that was previously siloed across spreadsheets and legacy systems, the platform provides an up-to-date, comprehensive view of hazards, enabling more proactive underwriting and asset protection measures. Notably, Prometheus features a conversational AI assistant that can be queried in plain English, allowing underwriters and asset managers to quickly ask complex questions about their exposures and get answers as if consulting a seasoned risk analyst. The launch is timely, with natural disaster losses at record highs and insurance capacity stretched thin. The industry is hungry for tools that can help anticipate and mitigate risk instead of merely reacting to it. Solutions like Prometheus exemplify the broader insurtech drive to augment human expertise with big data and AI, giving decision-makers clarity and speed in a world where risk is evolving faster than ever. Insurance leaders hope that harnessing such technologies will help stabilize coverage availability and support a more resilient real estate sector in the face of climate change. Real estate investment platforms. Over the past few years, online real estate investment platforms have transformed the way individuals participate in the property market, opening doors once reserved for institutional players. These tech-driven platforms, from crowdfunding sites to app-based REIT marketplaces, have drastically lowered the barrier to entry, enabling everyday investors to commit as little as $10 or $1,000 to property ventures that historically required tens of thousands or more. With intuitive mobile dashboards and transparent reporting, investors can monitor portfolios of rental homes or commercial buildings in real time, selecting among deals and strategies tailored to their interests, whether that's multifamily apartments, office developments, or real estate debt. This personalized, user-centric model has proven extremely popular. The largest U.S. direct-to-investor real estate platform now counts over 2 million users and manages billions in assets, evidence of a surging appetite to diversify into real estate through digital channels. By tapping into the savings of ordinary people at scale, these platforms are becoming a significant source of capital for property development and acquisitions, allowing sponsors to bypass traditional financing and enabling investors of all backgrounds to claim a stake in projects that shape local communities. For many investors, the allure of these platforms lies in the promise of steady returns and lower volatility compared to the stock market's daily twists and turns. Over the past year, several high-profile real estate crowdfunding platforms delivered mid-single-digit annual returns to their users, in some cases exceeding the performance of publicly traded REITs, while sparing investors the gut-wrenching price swings of the equity market. Because these are privately held funds that report values periodically instead of trading tick by tick, they often appear to provide a smoother ride, which proponents say helps keep investors focused on long-term income and appreciation. However, this comes with trade-offs. Most platforms impose limits on withdrawals, for example, limiting redemptions to quarterly windows, so investors must be comfortable with reduced liquidity and multi-year time horizons. Thus far, many find the balance worthwhile, attracted by the regular dividends, tangible asset backing, and potential for growth that these real estate investments offer. More people than ever can claim they own a sliver of an office tower or a share in a diverse property fund, a once unthinkable scenario that speaks to how fintech innovation has democratized real estate investing. Looking ahead, real estate investment platforms are evolving with new features to increase liquidity and expand investor reach. Some pioneers are experimenting with blockchain tokenization to represent property ownership as digital tokens, potentially allowing fractional real estate shares to be traded in secondary markets, much like stocks. One major platform recently even listed a unique fund on the New York Stock Exchange, giving everyday investors a chance to buy into a venture-style portfolio of private real estate and tech companies under a regulated ticker symbol. A striking symbol of how the lines between public markets and private real estate investing are blurring. As these platforms gain scale, Regulatory clarity is also improving. Securities authorities have been refining guidelines to protect investors and ensure transparency around fees, valuations, and risk disclosures. The competitive landscape is heating up too, with traditional financial institutions launching their own online real estate funds to compete with the upstarts, and leading crowdfunding firms branching out into areas like private credit and venture funds to broaden their appeal. After weathering the pandemic and interest rate swings, these real estate platforms have demonstrated endurance. Many in the industry now see them as potential mainstream fixtures, giving millions of people a voice and an ownership stake in the future of real estate development and investment around the world. Subtopic: Investment Platform News. Crowdfunding platform opens itself to investors. This week, Pittsburgh-based startup Redefine made waves by inviting the public to invest in the platform itself via a newly launched equity crowdfunding campaign. Everyday investors, with a minimum buy-in of around $1,000, can now purchase shares in Redefine parent company, effectively becoming part owners of the very real estate investment platform they use. Redefine operates a digital impact REIT model, enabling small investors to fund diversified multifamily housing projects, and it boasts a decade-long track record through its affiliation with a veteran apartment investment firm managing over $350 million in assets. By opening its own ownership to crowdfunding, the company seeks to raise growth capital while strengthening its community ethos, turning loyal users into shareholders who share directly in the platform's upside. Executives say this novel approach aligns incentives between the business and its member investors in a way that traditional fundraising doesn't, deepening trust and engagement as the platform scales up. Observers note that this move, essentially crowdfunding the crowdfunder, reflects a new phase of maturity in the sector, as some online real estate platforms turn to their user base as a source of capital. It's a trend that could accelerate as proptech and fintech innovations continue to democratize finance. The boundaries between investing in real estate and investing in the companies that enable real estate investing are growing increasingly fluid. Disclaimer: the information provided in Real Estate Intelligence Daily is for informational purposes only. Nothing in this report constitutes legal, medical, financial, or official advice. All content is news and analysis, not guidance or recommendations. Do not treat any of these anecdotal stories as advice. Always do your own research and consult qualified professionals before making financial, legal, or health-related decisions. Video description: YouTube Today's Real Estate Intelligence Daily, June 9, 2026, delivers a deep dive into 5 emerging trends shaping the property world. We explore how commercial real estate finance is responding to high interest rates and refinancing challenges, and why proptech and AI analytics are propelling the industry into a futuristic, data-driven era. Learn how smart building technology, digital twins, and predictive analytics are transforming property management, and how construction and development tech, from robots to modular building, is revolutionizing how we build in the face of labor shortages and climate pressures. We also cover how insurance and risk management strategies are evolving amid rising climate risks, and highlight the tech-forward solutions insurers and real estate investors are deploying to adapt. Finally, we look at real estate investment platforms and crowdfunding, where everyday investors are now participating in property deals like never before. Stay tuned for a comprehensive, hopeful outlook on the future of real estate, from financial markets to tech breakthroughs, and find out how industry leaders are navigating today's challenges with innovation and resilience. Plus, an FAA investigation into digital real estate portals signals that PropTech's rapid growth is attracting regulatory scrutiny. Video tags: SEO keywords, real estate news, commercial real estate finance, PropTech, AI in real estate, smart buildings, construction technology, sustainable building, climate risk, insurance and real estate, PropTech trends, real estate investment, crowdfunding, real estate market 2026, property investment platforms, commercial property market. Base thumbnail concept: a dynamic, eye-catching thumbnail combining visuals of a modern city skyline with digital elements to reflect technology and finance trends. The background features tall skyscrapers at sunrise, symbolizing the commercial real estate landscape, overlaid by a subtle transparent stock market chart or upward arrows, indicating market insights and finance. Superimposed in bold, attention-grabbing font is the title Real Estate Intelligence Daily, with the date June 9, 2026 visible, and a short tag like Top 5 Real Estate Trends or Big Deals and Tech Shifts to catch the viewer's eye. The color scheme balances professional blues or blacks with a dash of vibrant tech-themed colors, like neon blue or green lines, to communicate a futuristic, optimistic tone consistent with a positivist, tech-forward outlook. Thumbnail Variant A Finance Focus. This variation emphasizes commercial real estate finance by featuring an image of a prominent city financial district skyline or a skyscraper with money or stock ticker symbols. In the foreground, a bold upward arrow or stock chart motif suggests rising investments and market momentum. The text overlay could highlight a phrase like record CRE deals or capital flows surge in striking colors, e.g. green or gold, to appeal to viewers following market finance news. The overall look is sleek and professional, signaling an insider's financial insight into the real estate market. Thumbnail Variant B Tech Focus. This version spotlights the PropTech and AI angle, using a futuristic visual of a cityscape fused with digital graphics. For example, a silhouette of a skyscraper merging into a circuit board pattern or a holographic AI brain overlay on a building. The text might read Real Estate Plus AI or Smart Buildings Revolution in modern, high-contrast font. A subtle glow or neon color, like electric blue, underscores the tech theme, conveying a cutting-edge, innovation-driven vibe that highlights the role of analytics and smart technology in reshaping real estate. Thumbnail Variant C Futurist/Space Theme. For a bold A/B test, this variant introduces a subtle space-age twist to reflect visionary, long-term thinking in real estate. Imagine a dramatic composite image, a vibrant urban skyline that blends into a starry night or a rising Earth in the background, hinting at out-of-this-world potential and cosmic ambition. Perhaps a rocket launch or a planet silhouette appears faintly behind city skyscrapers, seamlessly integrated to symbolize taking real estate trends to new heights. The text might be a provocative phrase like future of real estate or next frontier in bright, hopeful colors, aiming to intrigue viewers with the promise of game-changing innovations and an optimistic, futuristic tone.